Ladies and gentlemen, we're sorry to interrupt your lunch, but it's my great pleasure to moderate and introduce what I think is going to be one of the highlights of the conference. Imagine for a moment a ruler. On the left-hand side, call it the stance of US monetary policy, whether it's measured in terms of interest rates, balance sheet, whatever. And then think about asset prices and growth. Maybe US bond prices, credit spreads, coming out to equities, and then out to Asian credit, asset prices, equities. Now let's take the ruler, let's put a little fulcrum there. Let's move the fulcrum a bit to the left. Whatever you say, that may be an oversimplification. The reason so many people are here today to listen to our speaker today is that US monetary policy is one of the key things that matters to this region, to growth, to asset prices, to risk. And it's therefore a particular pleasure to be able to introduce Charles Evans, the 9th President of the Federal Reserve Bank of Chicago, a voting member of the FOMC this year. Before he took up his current position, in September of 2007, he was the Vice President and Head of Research. He's much published as an academic economist. I think possibly he has a reputation as one of the clearest exponents of the policy framework that the Federal Reserve follows, or at least that he believes they're following and thinks they should follow. And I think his position this year on the FOMC is maybe particularly influential, but that is a matter for controversy. In any case, without further ado, please join me in welcoming Charles Evans.
Thank you very much. Thank you, Jonathan, very much for that very kind introduction. It's really a pleasure to be here today. Today, I'd like to briefly talk to you about my outlook for the U.S. economy before discussing some long-term economic trends and my views of appropriate monetary policy. And let me note that these are my own comments and they don't reflect the views of anyone necessarily, none of my colleagues or anyone within the Federal Reserve System. I'll start my remarks this afternoon with my outlook for the U.S. economy. My baseline outlook has real gross domestic product growing at a moderate 2 to 2.5% annual rate in 2016, and PCE inflation gradually approaching 2% over the next 3 years for the United States. But given the current economic landscape in the U.S. and internationally, I see the risk to both of these projections as weighted to the downside. I'll next discuss some underlying structural trends that are likely to have important effects on long-term growth prospects and interest rates in the U.S. and around much of the world. By most estimates, growth and real interest rates will be lower in the long run, and this is a new perspective relative to a few years ago. Monetary policy cannot alter structural trends. However, changes in structural trends do factor into benchmarking policy neutrality, and hence they have direct implications for monetary policy. I'll finish with my views of appropriate monetary policy in the U.S. You will see how these views are shaped by the structural trend benchmarks, the near-term economic outlook, and importantly, risk management considerations. Currently, I believe economic conditions imply it will be appropriate to take 2 more rate hikes this year and then follow a gradual path of rate increases thereafter. This is the policy path underlying my economic forecast. Of course, whether or not this path will in fact be appropriate depends on how the incoming data influence the FOMC's outlook for growth and inflation, as well as its assessments of the risks to those forecasts. All right, so that's the executive summary. Now let me turn to the outlook for the U.S. economy. I anticipate U.S. GDP growth in the range of 2 to 2.5% in 2016. So close to or a bit better than last year's 2% rate. The U.S. consumer is the linchpin behind this outlook. I think this winter's somewhat softer readings on consumption will prove to be transitory. This is because the most important fundamental factor for the U.S. supporting household spending is the substantially improved labor market. Over the past 2 years, the unemployment rate has fallen to 5%, half its 2009 peak, and job growth has averaged well over 200,000 per month. These gains have raised incomes and buoyed confidence over future job prospects. Lower energy prices and accommodated monetary policy have provided additional support to the spending wherewithal of households. All of these factors should continue to generate fairly solid increases in consumer spending, particularly given my assumption that interest rates will stay quite low for some time. However, juxtaposed against the relatively solid prospects for household spending, there are several factors weighing on economic activity in the U.S. The slowdown in global economic growth, notably in emerging market economies, and uncertainty about international prospects have contributed to a rising dollar and declining commodity prices since mid-2014. The trade-weighted dollar has appreciated almost 20% since June 2014, while oil prices are down around 65% over the same period. U.S. firms that sell their products in global markets and those exposed to commodity markets have felt the brunt of these relative price movements. All told, net exports have made noticeable negative contributions to U.S. growth in the past 2 years. As the uncertainties over foreign growth prospects resolve for the better, the upward pressure on the dollar should diminish and the international headwinds on domestic U.S. growth should dissipate. Still, I do not expect the international sector to be an engine for U.S. growth for some time. This view of moderate global growth is fairly mainstream. For example, in its latest projections, the International Monetary Fund expected world output to increase around 3.5% over the next couple of years. This is considerably slower than the 5% pace in the pre-crisis period. In part reflecting these global issues, financial conditions in the U.S. have tightened noticeably since the middle of last year, likely dampening the spending of both households and businesses. Indeed, business capital expenditures have been lackluster since late 2014, and the most recent indicators suggest that a rebound is unlikely in the near future. In a partial reversal, we have seen some improvement in credit conditions over the past several weeks. Hopefully, these will be sustained and contribute to further business sector spending not too far down the road. All told, I see real GDP increasing in the range of 2 to 2.5% over the next couple of years. This pace is somewhat stronger than where I think the underlying trend for growth is right now in the U.S., but not by a great deal. Now, as you probably know, the U.S. Congress has mandated that the Federal Reserve foster economic conditions with the aim of promoting two economic goals: maximum employment and price stability. So how are we doing in achieving these goals? Well, along with most of my colleagues on the Federal Open Market Committee, I judge that an unemployment rate that averages somewhat under 5% over the longer run is consistent with the Federal Reserve's maximum employment mandate in the United States. The current unemployment rate is 5%. However, a broader array of measures suggests that today there remains some additional resource slack in labor markets. By one such measure is subdued wage growth, a particularly important one. Well, let me be clear, we've made tremendous progress, but I'm not completely confident that we've met our employment objective just yet. I probably won't be fully confident until the unemployment rate is modestly below its long-run normal level. Now, given my outlook for growth, I expect the unemployment rate will continue to edge down to between 4.5% and 4.75% by the end of next year. So I do think the FOMC's employment objective is within sight. So what about the inflation objective? Well, the performance on this leg of the dual mandate has not been as good. In January 2012, the FOMC set 2% PCE inflation as the explicit inflation target consistent with our price stability mandate. However, over the past 8 years, PCE inflation has averaged only 1.5%. To get a sense of where total inflation is likely to be headed over the next year or so, I prefer to strip out the volatile and transitory food and energy components and look at so-called core inflation. Core PCE inflation also has run well below 2% for quite a long time. Over the past couple of months, however, core inflation moved up to 1.7% on a year-over-year basis. I'm encouraged by this development and have raised my forecast for core inflation in 2016 to 1.6%. Looking further ahead, I see both core and total inflation moving up gradually to approach our 2% inflation target within the next 3 years. This path reflects the dissipating effects on consumer prices of earlier declines in energy prices and the appreciation in the dollar, as well as the influence of further improvements in labor markets and growth in economic activity. However, I am a bit uneasy about this forecast. After all, central bankers worry a lot. It's too early to tell whether the recent firmer readings in the inflation data will last or prove to be temporary volatility and reverse in coming months. We saw this happen in 2012. And there are some other downside risks to consider. International developments may result in further declines in energy prices or greater appreciation of the dollar. Most worrisome to me is the risk that inflation expectations in the United States might drift lower. Here I find it troubling that the compensation for prospective inflation built into a number of financial market asset prices has fallen considerably over the past 2 years. More recently, some survey-based measures of inflation expectations, which had previously seemed unmovable, edged down to historically low levels. Yes, financial market inflation compensation and some survey measures of inflation expectations have risen a bit of late, but they still remain quite low. So to recap, I expect the U.S. economy will grow at a moderate pace over the next few years. This growth will be primarily driven by further increases in household spending. I also expect additional progress towards our 2% PCE inflation target. While I see this path for the U.S. economy as the most likely outcome, there are a number of downside risks to my outlook for both growth and inflation. Before discussing the implications of this forecast for my views on appropriate policy, I want to put my growth outlook in a longer-run context. By historical standards, my forecast of real GDP growth in the range of 2 to 2.5% doesn't seem particularly optimistic. It's in line with the average pace of growth since 2009, which is about 2.25%. By comparison, over the previous 3 expansions, real GDP in the U.S. growth averaged closer to an annual rate of 3.5%. The decline from 3.5% growth to 2.25% makes one sit up and take notice. What's going on? Why has growth in real activity been so subdued in the current expansion? Well, for one thing, the financial crisis and the ensuing Great Recession had far-reaching negative consequences, and we're all too well aware of these scars. With the support of accommodative monetary policy, these impediments to growth have been slowly dissipating. Nonetheless, I think these and other headwinds will take some additional time to fade away completely. In addition, as I survey the economic landscape, I see other factors that could hold growth back even after these impediments recede. Broadly speaking, an economy's long-run growth potential depends upon increases in its productive resources and the technological improvements that enable those resources to produce more. And these trends don't look favorable. One important productive resource is labor. Here, demographics are working against us. The U.S. Census Bureau projects that the population aged 16 years and over will grow a little less than 1% over the next 10 years. By comparison, between 1990 and 2010, the average annual growth of the adult population was 1.2%, much higher. Moreover, our population is graying, and consequently, fewer of us will be working. Over the next 10 years, the share of the population that is 65 or older is expected to increase about 4 percentage points from 15 to 19% in the United States. Since about 2000, this aging of the population and other long-running trends have been bringing down the fraction of the population participating in the labor force. My staff's estimates suggest that these structural forces will reduce the growth of available workers by about 1/4 percentage point per year over the next 10 years or so. Slower growth in available workers translates into less potential output growth. My staff also estimates that between 1980 and 2000, higher educational attainment and increases in workforce experience added more than 1/2 percentage point a year to labor quality. That is to say, the effective labor input into the aggregate production function for the United States grew 1/2 percentage point a year faster than the increase in total number of hours worked. However, further progress seems to have stalled, as new entrants to the labor force have roughly similar educational attainment as retiring baby boomers, but less work experience. This is another possible reason for slower potential economic growth in the United States. Economic growth over the longer run also depends upon technological progress and how it is integrated into business processes. By one carefully estimated measure, namely by John Fernald at the San Francisco Fed and his co-authors, the underlying trend in total factor productivity growth has declined. It was 1.8% during the 1995 to 2005 productivity boom. It is now a mere 0.5% today. That is in line with the period of low productivity growth that we experienced from the 1970s to the mid-1990s. We've gone back to the productivity slowdown era. Some economists, such as Robert Gordon at Northwestern University, think that the slowdown in trend productivity growth possibly is here to stay. Gordon argues that the search for transformative technologies that spurred productivity and economic growth in the past has become increasingly costly and more difficult to harvest. We have already picked the low-hanging fruit. His gloomy conclusion from this line of reasoning is that slow productivity growth will hold back potential economic growth for the foreseeable future. Not everyone subscribes to Gordon's view that TFP growth will inevitably slow because of the dearth of new invention. Rapid advances in the field of medicine and in energy production are two examples of where we have seen huge productivity improvements. Furthermore, it takes time for innovations to work their way into productive business technologies. It may be that transformative innovations are being created today, but have yet to make their way through the pipeline to show up as measurable increases in factor productivity. It remains to be seen if the current slowdown in productivity growth is temporary or more long-lasting. That said, the notion that longer-run potential growth is slowing is a view that has been gaining traction lately. This assessment is reflected to some degree in the median economic projections of Federal Open Market Committee participants for long-run potential growth, namely from 2.5% growth now down to 2.0% growth. When measured against these benchmarks, my forecast of real GDP growth in the range of 2 to 2.5% in 2016 is simply saying that the economy will expand a bit faster than its longer-run productive capabilities. This number is surely disappointing. We would certainly like stronger sustainable growth. But monetary policy alone cannot change labor force trends or technical progress. Still, the FOMC must recognize these changes in trends when setting monetary policy. Lower potential growth has profound implications. Lower potential output growth implies lower returns to investment. As a result, all else equal, equilibrium, neutral, real interest rates are lower in an economy with lower potential output growth. When inflation is at its target, the neutral federal funds rate is lower in an economy with a lower potential output growth. Therefore, the FOMC must take estimates of potential output growth into account when calibrating the stance of monetary policy. Of course, there are other reasons why equilibrium interest rates are likely lower than they were in the past. For example, former Fed Chair Ben Bernanke has frequently discussed the global savings glut. As the world population has aged and as residents of fast-growing emerging economies have grown wealthier, the saving rate in most countries has increased. This has resulted in a larger pool of funds seeking safe, profitable opportunities for investment. However, domestic investment opportunities in most of these countries often have not kept pace with the increased savings rate. This higher supply of investable funds relative to domestic demand has driven down interest rates across the globe. I'm sure everyone in this room is aware of that. In addition, former Treasury Secretary Larry Summers has expanded on these influences, speculating that soft aggregate demand worldwide has discouraged structural investment and capital stock growth. This is one view of the so-called secular stagnation hypothesis. These two ideas are closely related, the Bernanke and the Summers views. All of these factors imply that the federal funds rate, consistent with a neutral stance for monetary policy, may be lower than we used to think, than we were previously accustomed to. Now, how big might these changes be? Well, the March median FOMC participants' longer run nominal federal funds rate was 3.25%. 4 years ago, when forecasts of potential growth were higher, the committee was projecting the long-run funds rate would be in the range of 3.25% to 4.5%, much higher. Aging populations, lower productivity, greater propensities to save, increased demand for relatively safe assets, and declining real neutral interest rates are worldwide phenomena. Two recent studies, one by the IMF, another by the staff at the Bank of England, document how common these developments are in both advanced and developing economies. The studies also argue that these trends are likely to persist into the future, leading to lower potential growth for the overall world economy and lower real interest rates at both the short and long ends of the yield curve. So unless there's a significant increase in trend inflation rates, nominal interest rates will be low as well. To be sure, this isn't exactly new news. In advanced countries, real and nominal yields on long-term bonds have been declining since the mid-1990s. All right, so what's next for monetary policy? Lower long-run structural trends mean that even after policy is normalized, the federal funds rate will likely end up at a lower level than in the past. I'd now like to talk about what the transition path to that new level might look like. Again, I'm going to refer to the summary of economic projections. I have a chart here. All right, so here's the well-known and extremely valuable dot chart. Some of my colleagues have expressed different opinions of that. The chart shows each FOMC participant's views of the appropriate target federal funds rate at the end of each of the next 3 years and also in the longer run. These views are conditional on the data and outlook as of our March FOMC meeting. And as Chair Janet Yellen said last week in a speech in New York, these dots are not set in stone. They depend on the data. Focus for a moment on the median of the policy projections indicated by the red dots. The median participant expects only 2 more rate hikes over the remainder of this year, 2016, and then an additional 100 basis points or so of tightening in each of 2017 and 2018. By historical standards, this certainly is a gradual path. It's even slower than the so-called measured pace of increases that the Fed engineered in the 2004-2006 tightening cycle. That was 25 basis points per meeting, or 200 basis points a year. Now, at the same time, the median FOMC projection for the next 3 years envisions growth averaging slightly better than its long-run potential, the unemployment rate falling below its long-run natural rate, and inflation gradually reaching our target of 2%. Given such relatively good projections for the economy's performance, why is the median expected policy path so low? Well, naturally, I can't speak for my colleagues on the FOMC. However, there are several reasons why I think a shallow funds rate path, such as the one envisioned by the median FOMC participant, is appropriate. First, my forecasts for above potential growth and lower unemployment depend critically on the accommodative boost from a gradual path for policy rates. Given my interpretation of conditions today, a faster pace of tightening than the one I envision would lead me to a less optimistic economic forecast. Second, as I noted earlier, the FOMC needs to be concerned about inflation expectations slipping below its inflation target. If the public doesn't believe policymakers are trying to hit a symmetric 2% inflation target, it will be all that much harder for us to reach that policy goal. To convince the public of this, appropriate policy should provide enough accommodation to generate a reasonable likelihood that inflation in the future could moderately exceed 2%. Third, the very shallow path also reflects my view that the neutral level of the federal funds rate today is lower than its eventual long-run level. By some estimates, the equilibrium inflation-adjusted rate is currently 0. Chair Yellen mentioned that the other week as well. Assessing the degree of accommodation for today's actual policy needs to be judged against this benchmark. So the 75 to 100 basis point range for the median federal funds forecast at the end of 2016 is not terribly far from neutral. The equilibrium real rate should rise gradually as headwinds fade over time, and the policy path should follow these improvements. But it's going to take the data. The data will dictate how fast it takes place. And finally, my view of appropriate policy also provides for risk management. Here's a bit of what I mean. Faced with economic uncertainty and below target inflation while we're near the zero lower bound, policymakers could make two types of policy mistakes. The first mistake is that the FOMC could raise rates too quickly, only to be hit by one or more downside surprises. In order to put the economy back on track, we would have to cut interest rates back to zero and possibly even resort to unconventional policy tools, such as more quantitative easing. I think unconventional policy tools have been effective, but they clearly are the second best alternative to traditional policy and something we'd all like to avoid. I should note, too, that the economy facing a potentially lower growth rate and lower equilibrium interest rates, the likelihood of some shock actually forcing us back to the effective lower bound may be uncomfortably high. The difficulties experienced in Japan and Europe come to mind. Now, an alternative policy mistake the committee can make is that sometime during the gradual normalization process, the U.S. economy experiences upside surprises in growth and inflation. We get behind the curve. Well, policymakers have the experience and the appropriate tools to deal with such an outcome. We probably could keep inflation in check with only moderate increases in interest rates relative to current forecasts. Given how gradual the rate increases are in the baseline SEP already, policy could be made a good deal more restrictive, for example, by simply increasing rates 25 basis points at each and every meeting, just as we did during the measured pace adjustments of 2004 to 2006. I have a hard time buying the characterization that this is an overly steep path if inflation is in fact rising and growth is accelerating. So to me, concerns about the risks of rapid increases in rates in this scenario seem overblown. So to recap, let me stop. 2016 should be above trend in the range of 2 to 2.25%. I expect inflation will rise slowly towards our 2% objective over the next few years, but risks remain, and while we're close to the zero lower bound, there's a pretty good case for just taking it slowly, assessing the economic data, having confidence, and pursuing a gradual path. Thanks for your attention, and be happy to take your questions.
Thank you very much, Charles. It's the moderator's privilege to ask the first question and the last question unless someone else asks it first. Just the protocols on asking questions. Mics will be brought to you. I will discriminate in favour of the far reaches of the room, perhaps. Please keep your questions brief if you can. Charles, I was talking about productivity the other day to a number of different investors. And one of the things that came up was, how does the Fed kind of think about potential growth, productivity, in the light of so much talk about disruptive innovation, the other side of the Gordon coin, and how confident do they feel about forecasting productivity growth going forward, and how important is it when it is that in setting policy?
Well, productivity growth ends up being extremely important for any country, any economy. I mean, basically, your standard of living, in part, is going to come about from increases in productivity and wealth generation. In terms of what the Federal Reserve does, we're forecasting output growth. We're forecasting employment, labor input, and productivity is right in there in that identity. So the question is sort of like, what gives rise to increases in economic growth? And some of it is technology. Certainly we've seen a lot of disruptive technologies enter into the marketplace, displace resources. Resources are now scrambling to move into the other places. And it doesn't take much stretch of the imagination to imagine that that has some transitory negative consequences for productivity as these resources have to be redeployed. I can't say I know the answer on net as to how things are proceeding there. It's just that productivity growth has been slow as you measure total factor productivity, some concept of how these innovations are actually making their way into the business productive process. It's going quite slowly at the moment. So, I mean, on the one hand, we've seen strong employment growth with weaker output growth. That's also saying productivity has been lower. I think for central bankers, the real problem is going to be if unit labor costs start going up and we start to see inflation above target. That's what we're hoping to do, is to get inflation up to target. So maybe that's a piece of the puzzle that comes quicker than otherwise.
Thank you. All right, let's open it up to the room and see who wants to be brave enough to ask the first question. There's a question over here, and I've noted one over the far right as well.
Thank you, Mr. Evans. It sounds like it makes sense and to really run the easy monetary policy a bit longer. But what about the effectiveness of such an easy monetary policy? Right now, the market mentality seems to think that given the experiences in Japan and Europe, monetary policy seems to have reached the end of its effectiveness. What does the Fed think about this? Thank you.
Well, I think in the U.S., monetary policy has been reasonably effective. I mean, we've maintained interest rates at lower levels in an attempt to stimulate aggregate demand and an attempt to get inflation up. Inflation has been low for quite some time. I've been disappointed by the fact that it has not responded more readily, but I do think that our accommodative financial policies have helped stimulate the economy. Certainly, low borrowing rates have spurred auto purchases to the 17 million, 18 million ranges in the U.S., and that's been supportive. Mortgage rates are lower. I think that's helping somewhat as well. We have not seen that type of borrowing translate into faster business fixed investment, capital expenditures to the same extent. Part of this is the energy complexity with the fact that in the U.S. now we're producing more energy than we did before, and that's a relatively new development, and lower energy prices have been negative for that. But I think we need to get capital expenditures up in the U.S. because the capital deeping in contributions for growth have been much weaker over many years, and that's going to be part of getting productivity up over that time. But in terms of Japan and the other central banks, I look at their experiences of low inflation over a long period of time and concerns about policy not being very effective. And I would say we need to be proactive, aggressive, and get inflation up to target so that we don't wander back in the other direction and then have to test those limits.
Next question. There's one over there. Please go ahead.
Could you speak, when you speak about external risks that are now influencing concerns about how fast the Fed may move, can you just speak about the angles from which you look at the risks to the real economy, tradable goods, or investment internationally as compared to the financial markets and that balance of external risks?
I think most of the risks that I have in mind are the implications of those, if it's financial, but also, the demand from foreign economies, how it translates into demand for U.S. goods and services and the real side of our forecast. And so basically what we've seen is with some financial volatility and risk aversion and uncertainty as to how the deceleration in growth in China is proceeding to, higher single-digit rates. We've marked down, our assessment of worldwide growth, and then consequently its influence on the U.S. has been a little bit negative, but we were able to offset that in many of our individual forecasts by slightly more accommodative monetary policies. And so it's really the international factors and how it affects the U.S. economy that really drives our policy at the moment.
Next question, please. I think we have one over there.
Just wondering, in terms of risks, to what extent, if any, does the FOMC take into account political uncertainty, and particularly in a presidential election year? Does that factor at all?
Well, every 2 or 4 years we have an election, national election in the U.S., and, we have to continue to make monetary policy even in the environment of uncertainty. Sometimes there's less uncertainty about the differential policies that would be pursued by the different candidates at the moment. There are a lot of things up in the air and lots of proposals, and if you're a business person or anybody contemplating investments, there's uncertainty, and so I can imagine that has some type of effect. What is important for the Federal Reserve and any central bank is that we be allowed to continue our focus on the medium-term economic consequences for, in our case, maximum employment, growth in the U.S., and also inflation. And so we're going to continue to set policy in order to keep the economy running, in order to keep labor markets vibrant and get inflation up to 2%. But as uncertainty increases, it becomes even more difficult for us. And so, we might have to respond in that sense. But we have to do it in a way that is somewhat independent of short-term political pressure. That's what central banks, that's part of our job.
Next question. I think we have one right at the very back. I think from the media table.
Yes, thank you. We hear from the FOMC releases, from the statements, from the speeches of Chair Yellen and other FOMC members, a lot about data dependency. And I was wondering whether that's not too much of a backward-looking stance for a central banker?
Well, it's always interesting when people say you don't really want to look back, you want to look into the future. The future's never evident, is it? I mean, the only way you can really see the future is by looking at the present and trends in the data and whatnot. So when we say data dependence, we have to have some viewpoint on where the economy is going. That's why I talked at some length about my forecast for 2 to 2.5%. Then when confronted by some new data development, uncertainty or a change in oil prices or whatever it is, you look at how that affects the outlook, and then do you need more or less accommodation? That's what we mean by data dependency.
Can I just follow up with
Sure.
that slightly? There's a little bit of a discussion going around at the moment about whether oil prices, super low oil prices, actually the negative effects on business investment, possibly credit supply and so on, are actually slightly larger than the positive effects on consumer spending. So that if oil prices fall below a certain level, it sort of swings the balance in terms of. That's kind of one of the data dependency things that you think about. Do you have a view on that particular question?
Well, I think that's a relatively new structural feature of the U.S. economy. I would say that 20 years ago, we didn't really think that low energy prices would cause as many headwinds for business fixed investment because we didn't produce as much energy. We certainly didn't think about producing it to export, but now with the lower costs of fracking, relatively high energy prices, and we can bring more sources of oil, online very quickly, or reduce them when oil prices go down. So I can't say I have a firm, strong assessment of what the structure is in the U.S., and we have probably been a little surprised that the low gasoline prices didn't translate quite as quickly into stronger consumer spending like you might have imagined. I think in part, I would say that all of the households' dividends that came from lower energy prices, they have been using productively, but it may not have all been in terms of goods purchases. They also have debt levels that they'd like to reduce, and there's been continued improvement in household balance sheets. And so I think that the consumer has been able to clear the table as much as possible so that as wages begin to increase, we can see even stronger consumer spending. But yes, you're right. I can't say I know exactly that I have a firm opinion on how beneficial or how negative it might be for business fixed investment. We need to keep studying that.
Next question. One from the core. If we can get the microphone here, please.
Low interest rates have been pretty effective in keeping stock markets at high levels, property prices stabilized at high-ish levels. But they've been quite injurious to savers, to retired savers, and quite injurious probably to the long-term pension fund industry, which expects returns, has been selling annuities on the basis of returns 6, 7, 8%, and it's clearly not going to get that certainly from the bond market. So is that an area, shouldn't that be an area that someone, if not the Federal Reserve, ought to be concerned about?
So I think I've heard that question before in the past, and I think the premise of your question is that somehow monetary policy, like Fed monetary policy, is playing a very important role in the low interest rate environment. And well, it's certainly the case that we've kept short-term policy rates low. And well, I was just taking credit for the fact that auto borrowing rates are low too. So I think that is part of the transmission. But it is very interesting that 10-year Treasury rate in the U.S., I think, is about under 1.8% right now. I'm confident that our asset purchases lowered term premiums, lowered long-term interest rates, but 1.8% at the moment, there is much afoot that is not just monetary policy in the United States. The worldwide slower growth, the uncertainty that other economies are facing, and the amount of savings that is looking for safe haven assets, I think is a good part of that. I don't think that conditions are sufficiently strong so that if we did decide just to autonomously increase short-term interest rates by quite a lot in order to try to address some of the issues you're talking about, that would ultimately be good for those interest rates, because I think it would curb growth and we'd end up back in a zero lower bound world. And so I think the prescription really is to organically try to get interest rates up through stronger growth and inflation back up to target, and that's the most sustainable outcome. I know that a lot of people have been hurt by the change in compensation for accumulated savings, and in a better world with better growth, maybe that'll turn around.
One more question? Oh, okay. it's a short head over there.
Mr. Evans, given the wave of central bank activity and policy post-GFC, has there been a central bank that has surprised you and your colleagues to the upside with their policy intervention?
I'm sorry, I didn't hear that question very well. Could you just repeat it?
Has there been a central bank that has surprised you and your colleagues at the Fed to the upside with their intervention or policy that they've brought to bear?
I think we've been through a very challenging time period. I've been doing this job for 8.5 years, since September 2007. We thought that most of the problems started off in the US, but then things moved to Europe, and the banking system in Europe, I think, was extremely challenged then, plus the European Union itself and the stability of that with Greece and challenges there. I think it's been very difficult for everyone to take aggressive actions, to come to the judgment that aggressive actions have been necessary in all cases. Perhaps understanding the risks that we were facing was not the easiest thing in the world, and it could have come out differently. But over the course of that time, I think that the Bank of Japan, the ECB, and other central banks have taken very strong and now proactive actions in order to get on top of this. But even in the US, I think there were times when I would have hoped that we could have done more quickly. Finding a consensus within the central bank governing authority is very important in order to maintain and sustain those actions. And so sometimes that takes longer. But there have been good moments during that time period.
Well, I think I'm going to exercise my privilege and ask the last question,
All right.
if I might. I wondered if you would like to make a couple of comments on 1937 and what happened then, and whether it has any relevance to today. And I'll add one last comment, which is one possible explanation for the low level of term risk premia is the idea that policymakers or other accidents might have non-linear effects on the economy, and that there's a sort of inbuilt bias to think that any non-linearities are more likely to be on the downside than on the upside.
Well, I think Jonathan is referring to a conversation we had before the luncheon, where we were just sort of making comparisons to the interwar period and earlier times, and long periods of difficult economic activity following a financial crisis, sort of Reinhardt and Rogoff types of episodes, but in the U.S. And I just sort of pointed out that one thing that you might be nervous about is, well, in 1937 the economy was doing a little bit better, and then they kind of embarked upon more restrictive fiscal policies and monetary policy, at least through increasing reserve requirements. Whether or not the banks had enough cushion or wanted more is a question. So we're just at about the duration of the current expansion after the Lehman downturn. I don't want to be superstitious or anything like that, but I continue to think that we've got good fundamentals in the United States. The consumer is stronger, labor markets are better. We want to make sure that continues, to the extent that a stronger U.S. economy helps support the rest of the world as the rest of the world supports themselves. I think it's to everybody's benefit, and so I think that just solidifies a case for let's go about being careful, have confidence we're going to get inflation up to 2% and be gradual, and then if we're lucky, we can increase rates more quickly as inflation increases and the economy goes up. So that's my view. Thank you.
Well, thank you all, ladies and gentlemen. Thank you very much, Charles.